Imagine a top 5 Indian bank losing 27% in a single trading day. That's the 18,000 crore shock IndusInd Bank gave us on 10th of March 2025. I am Yash and welcome to my channel. Here we break down finance in the simplest way possible. No jargon, no confusion, just straight up fun learning. Whether you are a beginner or a pro, get ready to explore finance like never before. Today we will unpack what went wrong step by step and learn 6 big risk lessons every investor and finance student must know. First, I'll give you some concepts and then we will connect the dots and understand the whole scene. So just stay with me for the next few minutes. So first, we need to understand how bank earns money, right? Like you can see my screen on my screen as well. Here you can think a bank works a bit like your neighborhood grocery store. It buys money cheap, your saving deposit at let's say 3% and sells money dear, home loans let's say at 9%. So that's the spread, and this spread is called as net interest margin. Here you can see on my screen as well, net interest margin. So that's what the major income of the bank, right? But here's the twist: the store's stock is not even its own. A bank lends money that actually belongs to depositors and other lenders, right? And that is called as leverage, right? Because whatever the money the bank is lending to others, it's not belong to the bank, it belongs to the depositor and other lenders. And this heavy leverage makes banking profitable, but at the same time it's a highly risky business. One wrong bet and the margin vanishes totally. Now we will understand two important desks and roles of those desks. Here you can see on my screen as well. So two desks which are very important in the banking sector. First is ALM desk, which is called as asset liability management. The asset liability management actually, it's a very important and crucial desk. It matches the cash flow inflows, deposits, loan repayments with cash outflows, withdrawals, bonds, redemptions. So the goal of the asset liability management is to ensure the liquidity. So no customers here sorry, cash nahi hai, right? So that's the main goal of the asset liability mismatch. So that's the role of the asset liabilities ALM desk in the banking sector, in the banking organization. Second is the trading desk. Trading desk usually invests surplus cash and runs a treasury book actually, bonds, currency, derivatives. So the main goal of the trading desk is earn extra return but stay within risk limit. So think of ALM as the family accountant who actually balancing income and expenses, and trading as the cousin who invest any leftover cash in the market. So that's a sort of the analogy I want to give you so that you can understand these two desks, which are quite crucial and very important, and the roles of these two desks in the banking sector. So now I'll walk you through a bit about currency mismatch. So IndusInd, like many Indian banks, raise fund in US bank, in US dollars, and but here the reason is why. Dollar interest rates were under 3% and rupees loan under 9%. That's a lovely spread actually, because they raise the loan at 3%. The loan rate in dollars are, I mean, quite low in comparison to the raising the loan from the Indian market in the domestic market. So that's why they took the leverage of raising deposits, raising money at a very lower rate in dollars and lending the same amount in rupees in domestic market at a very high rate, maybe around 9%. So that's a quite good spread. That's a quite lovely spread, which actually helps the bank to earn more, right? So here you can see on my screen as well, let's say maybe they raised a money of 1,000 rupees at a very cheap rate, maybe at 3%, convert to rupees and lend it at 9%, which is quite high. So that's the way they can earn very good. But the thing is, there's a catch. Problem is if USD appreciate to 90, right? Let's say you raise the money at 87 rupees of foreign exchange rate, but uh, maybe after some time the rate of the US dollar increases to 90, right? So if USD appreciate to 90, the bank suddenly needs 90,000 plus to buy back the same $1,000, because if they raise the money, right, 1,000 US dollars, then after some time they have to pay back as well, right, to the depositor, to the investors. So for that matter, if after some time the USD exchange rate raised from 87 to 90, then they have to actually pay more rupees to buy back the same $1,000, right? So that's the exchange rate risk can wipe out the margin, right? So that's one of the big risk while you raised the money in foreign currency, let's say in dollar, and provide the fundings and lending money in domestic currency. So now here you should understand what hedging is, right? To neutralize the risk, bank actually uses hedges. And how they use hedges? Actually through the financial insurance. So one of the common tool of hedging is a currency swap. The bank locks in today's rate for a future exchange. Think of it like fixing the prices of mangoes for summer today, so you are safe even if mango prices double up in near future. So good hedge always provides stable profit, but bad hedge, or maybe if there is missing of hedging, then it will result into painful surprises in future. And usually in bank, there are two ways to hedge the risk, right? To hedge the FX risk. So the first way to hedge the risk is external hedge, where the bank uh, does the contract with the another bank, right? And by law, you have to book the profit and losses at MTM level, at mark to market level. All the losses, all the bookings of gains or losses have to be report in the books of accounts at MTM level as rates moves up and down. So that's external hedge, right? So in external hedge, majorly you have to do some sort of a contract with the outsider party, and you have to book gain and losses at MTM level, right, in the books. While on the other side, there is internal hedge. In internal hedge, ALM does a swap, the asset liability management desk does a swap with its own trading desk, right? So it's an internal hedge. You are performing hedging, you are performing some sort of or executing a contract with your within your company only, right, with other department. So that's internal hedge. So ANM does a swap agreement with its own trading desk. Like I explained earlier, there are two desks. First is ALM and second is ALM and second is trading desk. So ALM desk, the first desk is executing a contract with other desk, which is trading desk. So that's internal hedging. So in case of internal hedging, actually until 31st March 2024, Indian rules let banks keep these all sort of internal hedging at cost only. So the accounting of the internal hedging was going to be performed at cost, no daily MTM. You don't have to book the gains or the profits or the losses at MTM, at mark to market level, right? So you have to keep all the contracts at the cost only. But on 1st of April 2024, the RBI said time's up. Even internal deals must be MTM. So what does it mean? So in case of internal hedge also, you have to provide for the losses, you have to record the losses or the gain at mark to market level, right? So irrespective of the sort of hedge, irrespective of the way of hedge, either external or internal, you have to record all the gains and losses at MTM level, at mark to market level. But what exactly the meaning of this RBI notification on 1st of April, which actually triggers the internal hedge to report all the losses and gains at MTM level? Because of it, all the hidden losses must hit the profit and loss statement immediately. Because if a bank is performing some sort of internal hedge, then 1st of April onwards, they have to book all the profit and losses immediately as per RBI notification at MTM level. But here's the catch. IndusInd Bank actually had piled up on long dated internal swap for 8 to 10 years. But even after April, the notification of RBI to report all the internal hedges as well at MTM only, they reportedly and they reportedly kept the old cost method for months for a long period. They didn't report any sort of gains and losses at MTM level for internal hedging because they were performing internal hedging at a very high level. The volume was very high. And as a consequence of RBI notification on 1st of April, they must record all the gains and losses at MTM level on 1st of April onwards. But even after the notification of RBI to report internal hedging at MTM level, they reportedly kept the old cost method for months for a long period. And around October 2024, finance team actually noticed a growing gap. MTM losses were nowhere in the books. And on 10th March, they told the stock exchange about the misreporting of the derivative loss, and boom, share price collapsed 27%. But now, before the tidal waves, we usually get some signals as well. And that's the same way we got some signals as well in case of IndusInd Bank too. And what were those signals? So I'll now let you know those four signals. There were many early warning signs at that time, but four of them were very crucial and important to understand. First one is CEO got only 1 year extension from RBI instead of 3 he wanted. Usually, a bank has to get approval of RBI to extend the tenure of CEO of bank. And in case of IndusInd Bank, RBI just extended the tenure for 1 year instead of 3 years, which was a big red flag actually. So this was the first red flag. Second is CFO resigned overnight on 20th of January 2025. And it's highly unusual in fifth largest banking company. Usually, a key person of the bank takes time to leave the organization instead of immediately vanishing from the organization. So this was the second big red flag. Third one is top bosses sold large personal stakes as ESOP near at all-time high of 1,500 rupees months before the news. So this shows that they knew the internal discrepancy, right? But before made it public, they dumped their holding at an all-time high and booked their own profit. So this was one of the biggest third red flag. And the last market-driven external red flag was that the derivative data, which was screaming bearish like a hell, because open interest doubled while price drifted lower from November to March, from November 24 to March 2025. Now here, few of the people may not be able to understand the meaning of open interest. So I would put some light on this concept. So what do I mean by derivative data screamed bearish? So open interest is simply total number of outstanding futures and contracts. Total number of outstanding futures and contracts. Right. So think of it as how many bets are still alive, right? Futures and futures and contracts. How many bets are still alive? This is open interest, right? So when open interest rises while the underlying price keeps falling, it means more traders are adding fresh short position, piling on to the view that the price will keep dropping. So in the case of IndusInd Bank, the open interest was keep on rising and the price of the stock keeps on falling. So it means more traders are adding on fresh short positions, right? and piling out to the view that the price will keep on dropping. The price of the stocks of the IndusInd Bank will keep dropping. So you can picture a bus that's already rolling downhill, price down, and more passenger keep jumping on with tickets that only pay out if the bus goes further downhill. That's so it's like a news of shorting. So that's a strong negative signal. So between November 2024 and March 2025, November 24 to March 25, IndusInd stock price slid from roughly from 1500 to under 1200, and yet open interest in its stock futures doubled. So more riders, steeper hill, and classic bearish divergence actually. So in technical terms, this pattern is called as price down, open interest up divergence, and is often an early warning of deeper trouble ahead. So these were the important early warning indicators of IndusInd Bank crash. So here I can remind one of the sayings of Warren Buffett too. If you spot one cockroach, and you should assume that there are many more, because they actually come in together, right? They don't come individually. So these inconsistency and red flag led to estimated accounting hit of around 2000 around 2000 crores of rupees, which is about 2.35% of net worth of IndusInd Bank. And because of that, there's a capitalization loss of around 18,000 crore, which is nearly 9 times the accounting loss. So here what we can learn from this incident, here we can learn a lesson that market punishes surprise more than actual rupees losses. And that's what you can see even in this case as well. The estimated accounting loss was of 2000 rupees, 2000 crore rupees, but actually the market capitalization wiped off of 18,000 crore, which is 9 times, 10 times. So this scenario of IndusInd Bank provides actually 5 crucial takeaways. First, I wanted to quote that leverage actually magnifies mistakes. So more leverage you see in any banking or financial institution, then it can create more problems in the scene. Second takeaway is MTM is reality, mark to market. Ignoring it only delays pain, because delays of mark to market booking of profit and loss will hammer so strong, like it will destroy the things significantly, like the way it did in IndusInd Bank as well. Because in IndusInd Bank too, they just delayed the MTM booking, and when they again reported all the profit and loss after getting to know about the discrepancy in the accounting, all the profit and loss in total when they booked, then it hammered like very strong that it destroyed the complete capitalization of the bank in the market, and even the accounting losses peaked to 2000 crore rupees, which is very huge for a bank like this, and that too in India banking system. Third is third a very crucial important takeaway is action are actually louder than words, because in case of IndusInd Bank, resignation and share sales speak louder than press notes, whatever the press notes they released actually. So we should be very skeptical about the actions more than the words, right? Of the senior management, of the board, of the governance of the banking organization and financial institution, because actions are more louder than words. The fourth, a very important takeaway is regulator signal matters, because in case of IndusInd Bank too, a shortened CEO tenure is not routine, right? Because RBI approved the tenure, approved the extension of the tenure of the CEO just by 1 year. Instead, they wanted to extend the tenure of the existing CEO to 3 years. So be cautious about this type of unusual activities, because regulators actions actually signals a lot in the market. And the fifth one, and the very important takeaway, is watch the future markets, because rising open interest plus falling prices usually mean smart money is short, not just internal. Many times external indicators like increasing open interest and decreasing prices indicators also warn us about the organization, right? About the banking sector. So be proactive to analyze those external indicators too. Don't ignore that. Don't avoid that. That all these indicators are just because of the speculation in the market. So these were the 5 takeaways I wanted to share with you for this case study. But few of the people still were asking me, is IndusInd Bank is the next Yes Bank? But here I would say, right now I can't comment as of now, because capital cushion of IndusInd Bank still suggests their balance sheet is quite healthy. But at the same time, trust takes years to rebuild the investors and customers' confidence. So that's a big challenge still here for the IndusInd Bank. And here I would say, whether you are like preparing for exams or managing a treasury risk, treat this as a live case study in risk, governance, and market psychology. Because even if the capital cushion looks very okay, but it's very much difficult to rebuild the trust of all the customers and the investors. The capital adequacy ratio of the IndusInd Bank is very good right now. It's healthy. Even the liquidity coverage ratio is also healthy. It doesn't seem like that, like right now there can be a bank run, but still it actually um, shaken up the confidence of all the customers and the investors. So for that matter, IndusInd Bank still struggles to rebuild that up. So here I would say, so uh, you should be very proactive whenever you are investing something in the banking sector, especially because banking sector is quite volatile sector, and correlation of the banking sector with other sectors are quite high. So before investing or before making some sort of big decision with the banking and financial institution, you should be very skeptical with the external factors along with the internal factors as well. And also do some focus, or also do some research on the regulators actions as well, on those institutions, on those banking organization in which you are going to invest, or in which you are going to invest, or maybe do some contracts with them, right? So now I'm want to end this uh, video and end this discussion. And if this breakdown made banking clearer, then I would request to hit like, share with your friends, and subscribe for more finance in simple language, so that they can understand and absorb the financial world in a very easy way, and to avoid all those of jargons and technical words, because some of the times I feel for a very common man it will get overwhelming to understand the financial sector, and that's why they usually given up to understand. So please stay with us. We will make you a better equipped with finance knowledge. So that's it for today. And until next time, manage your risk before it manages you. Thank you so much. Bye bye. Take care.